Do you know that the Chinese economy is collapsing? China is one of the largest economies in the world, and it has been experiencing a significant increase in its GDP over the past 3 decades. However, the economy of the Asian giant is facing significant problems. With these significant challenges that China is facing, it's crucial to understand the factors contributing to this crisis and its potential impact on the global economy. If you are ready, let's get into it. Cyclical factors. One of the cyclical factors affecting China's economy is the aftermath of the COVID-19 pandemic. The global pandemic has undoubtedly sent shockwaves through economies worldwide, and China, as the epicenter of the outbreak, was one of the hardest hit. The strict measures implemented to control the virus resulted in severe disruptions across various sectors, causing a significant economic downturn throughout the country. The initial impact on the Chinese economy was primarily felt due to the restrictions imposed on physical movement, affecting supply chains, production, and transportation. The domestic and international demand for Chinese goods and services was considerably hit. Then, a decline in exports followed. China is known as the world's largest exporter of goods, from electronics to textiles. However, the pandemic-induced global lockdowns and decreased consumer spending affected the demand for Chinese products, resulting in a decline in exports. The reduced demand from key trading partners such as Europe and the United States, coupled with disruptions in global supply chains, dealt a blow to China's export-oriented economy. This further led to job losses and financial struggles for many Chinese businesses relying heavily on international trade. In addition to the decline in exports, China's service sector faced significant challenges during these unprecedented times. Industries like tourism, hospitality, and entertainment suffered major setbacks with reduced travel and strict containment measures. As the pandemic forced people to stay home and limited the number of visitors, tourism within China experienced a sharp decline. It subsequently affected related sectors such as hotels, restaurants, and airlines, which heavily rely on tourism revenue. The loss of income for businesses and individuals in these industries further strained the Chinese economy. However, things didn't improve even after the government relaxed all the COVID restrictions. The pandemic has left scars on the economy, including deteriorating balance sheets, an ailing property sector, and limited macroeconomic policy responses. These factors have contributed to a slowdown in consumption, production, and investment, and a rise in unemployment rates. Another cyclical factor is the rising debt levels within the Chinese economy. The Chinese government encouraged lending to stimulate economic growth, resulting in a debt surge across various sectors. This has led to concerns regarding the sustainability of China's debt burden and potential financial instability, casting a shadow over its economic prospects. Lastly, demographic shifts pose another cyclical factor affecting China's economy. The country is witnessing an aging population and a declining working-age population, partly due to the one-child policy implemented in the past. This demographic change challenges the labor market, social security, and economic productivity. It burdens the government to support retirees and maintain sustainable economic growth adequately. The government must recognize these factors and implement appropriate reforms and policies will be essential for China's sustainable economic growth in the future. Structural pressures. Alongside the cyclical factors, China also faces structural pressures impacting its economic outlook. One of these pressures is regulatory concerns. Although regulations are implemented to maintain stability, ensure fair competition, protect consumers, and foster an environment conducive to economic growth, regulatory concerns can adversely affect business operations and investor confidence when perceived as excessive or unpredictable. One significant area where regulatory concerns have impacted the Chinese economy is the crackdown on technology giants. In recent years, companies like Alibaba, Tencent, and Didi have faced increased scrutiny and regulatory pressure from the Chinese government. Concerns over monopolistic practices, data security, and financial risks primarily drove these actions. The regulatory measures implemented by the government, such as antitrust investigations, hefty fines, and restructuring mandates, have disrupted the operations of these tech giants. This has led to a decline in investor confidence, reduced market valuations, and a slowdown in investment in the technology sector. The negative sentiment has also affected the overall business environment in China. Alongside business regulation, the Chinese government has also implemented measures that regulate the financial sector. Recently, a focus has been on reducing systemic risks and curbing excessive lending practices. Measures such as tighter regulations on shadow banking, stricter lending criteria, and increased oversight of financial institutions have been implemented. The impact of regulation is also felt in foreign investment and acquisitions. Although these practices are put in place to create a more stable economy, the perception has made people not spend in a way that will see rapid economic recovery in the country. Sometimes the perception of the seasonal economy is more important than the actual state of the economy. The crackdown on tech giants, financial sector regulations, and tighter foreign investment and trade controls have disrupted business operations, reduced investor confidence, and affected economic growth prospects. In addition to regulation, China has faced cybersecurity issues, theft of intellectual property, increased tensions with other nations, and geopolitical conflicts, all of which have contributed to mounting security concerns. One significant consequence of security concerns in China has been the negative impact on foreign investments. With heightened cybersecurity risks and intellectual property theft, foreign investors have become wary of investing in Chinese companies. This problem has reduced foreign direct investment, FDI, and slowed economic growth. Consequently, domestic entrepreneurship plays a crucial role in any thriving economy. Nonetheless, security concerns have created a chilling effect on Chinese entrepreneurs. With increased state surveillance and stringent regulations, many prospective entrepreneurs fear the risks of starting a business. This stagnation in entrepreneurship has curtailed innovation and economic diversification. Property sector. Although cyclical factors and structural pressures have impacted the Chinese economy negatively, nothing has dealt a more significant blow to the economy than the property sector crisis. The potential collapse of the property sector could have severe consequences for the economy, including losses in household wealth and economic growth. Let's see how the property sector crisis has affected the country's economy. One of the primary reasons the property sector crisis has negatively impacted the Chinese economy is overheating and speculative investments. The surge in demand for housing has led to inflated property prices, making home ownership unaffordable for many individuals and families. Moreover, people started investing in multiple properties, hoping for greater returns, leading to a speculative bubble that raised concerns about financial stability. Also, the property sector crisis has raised concerns about a potential housing market bubble burst. A significant decline in property values could lead to an economic downturn, affecting various sectors of the Chinese economy. Banks in particular may face increased risks, as many loans are associated with the real estate market. This scenario could result in a chain reaction, further amplifying the crisis. Interestingly, the negative consequences extend beyond the economic sphere. The property sector crisis has worsened wealth inequality in China. As the housing market became increasingly unaffordable, the average person struggled to attain home ownership, creating a divide between the rich and poor. This wealth disparity has contributed to social unrest and societal tension, posing a challenge to the government's efforts towards social stability. China's property sector crisis has also ripple effects on various industries. Construction, for instance, suffered as projects were put on hold or scaled back. This slowdown affected related sectors such as steel, cement, and furniture, leading to job losses and reduced economic growth. Additionally, the decline in property sales negatively impacted the finance and banking sectors, causing overall economic instability. The property sector crisis has undeniably taken a toll on China's economy, resulting in overheating, speculative investments, wealth inequality, and social unrest. While the government has implemented measures to mitigate the crisis, the long-term effects and future outlook remain uncertain. We hope that China's economy will find a way to navigate and overcome this challenging period. An example of China's worsening state in the property sector was seen in 2021. Evergrande Group, one of China's largest property developers, faced a severe debt crisis in 2021. The company's financial troubles raised concerns about systemic risks in China's property sector and broader implications for the global economy. Evergrande's debt uncertainty caused volatility in financial markets, particularly in the real estate and construction sectors worldwide. Global impact of worsening economic conditions in China. China, the world's second-largest economy, is crucial in shaping the international economic landscape. The potential long-term consequences of China's economic crisis could significantly impact domestic and global levels. Here are some critical consequences. Trade and exports. China is known as the world's factory due to its significant role in global trade. Any disruptions in China's economy can ripple effect on international trade. As China's economic conditions worsen, there is a potential decline in demand for imported goods and raw materials. This challenge can negatively affect exporting countries, particularly those heavily reliant on Chinese markets. Supply chain disruptions. Another crucial aspect to consider is China's role in global supply chains. Many multinational corporations rely on Chinese manufacturing capabilities and supply chains to produce and distribute their products worldwide. If China's economic conditions deteriorate further, it could lead to disruptions in the supply chain, affecting businesses worldwide. The impact was evident during the COVID-19 pandemic when lockdown measures in China caused supply chain disruptions across various industries. Commodity prices and emerging markets. China's economic performance also influences commodity prices such as oil, metals, and agricultural products. As China's demand for commodities decreases, it can lead to a decline in global commodity prices. This problem affects commodity exporting countries, particularly emerging markets that heavily rely on commodity exports for economic growth. Reduced demand from China can lead to economic challenges for these countries. Financial markets and investor sentiment. China's economic conditions can significantly impact global financial markets and investor sentiment. Financial markets are highly interconnected, and any signs of economic instability in China can trigger volatility in global stock markets, currency exchange rates, and investor confidence. For instance, in 2015, China experienced a significant stock market correction, with the Shanghai Stock Exchange Composite Index falling by around 40%. This situation caused a wave of panic in global financial markets as investors worried about the health of China's economy. Stock markets worldwide experienced sharp declines, contributing to increased volatility and uncertainty in the global market. This development demonstrates the interconnectedness of economies and the importance of China's economic stability for global financial stability. How to turn things around. Undoubtedly, the Chinese economy has faced significant challenges in recent times. However, the Chinese government can navigate these challenges effectively with proactive measures and strategic planning. Strengthening domestic consumption. One key strategy is to boost domestic consumption. The government can achieve this by implementing policies that promote higher wages, income redistribution, and social safety nets. Enhancing disposable income will encourage consumers to spend more, stimulating economic activity and demand. Supporting small and medium enterprises, SMEs. SMEs are the backbone of any economy, and China is no exception. The government should implement policies that provide easier access to credit, reduce bureaucratic hurdles, and offer tax incentives for SMEs. The government in Beijing must nurture entrepreneurship and support small businesses because that will drive job creation and foster economic growth at the grassroots level. Strengthening international trade relations. China has long been a global trading powerhouse, and maintaining strong international trade relations is vital. The government should focus on diversifying export markets, negotiating favorable trade agreements, and improving market access for goods and services. By expanding trade opportunities, China can mitigate the impact of economic fluctuations and broaden its economic base. Attract foreign investment. Foreign investment is essential to the growth of any economy. The Chinese government can increase direct foreign investment through various ways. First, simplifying regulations and enhancing business ease is crucial to attracting foreign investors. The Chinese government should focus on reducing bureaucratic hurdles, streamlining administrative processes, and providing clearer guidelines for foreign investment. By creating a business-friendly environment, foreign investors will feel more confident and willing to invest in China. Second, intellectual property protection is a significant concern for foreign investors. Strengthening intellectual property laws and enforcement mechanisms is essential to instill confidence in foreign companies. The Chinese government should prioritize the protection of patents, copyrights, and trademarks, ensuring that foreign investors' intellectual property rights are safeguarded effectively. Lastly, attracting foreign investment requires a combination of measures. With these measures, the Chinese government can create an environment that fosters foreign investment, driving economic growth, job creation, and technological advancement. Facilitating market access and trade liberalization. The Chinese government can improve the economy and the overall entry of foreign investment through trade liberalization. There are several ways to facilitate market access and trade liberalization, such as reducing trade barriers, improving transparency, and promoting fair competition. China can become an attractive destination for foreign investors. Give incentives to targeted sectors. Government subsidies will help the economy grow. The government can follow the steps taken by European countries and the United States to offer incentives to areas such as high-tech and innovation. Encouraging investment in high-tech industries such as artificial intelligence, AI, robotics, biotechnology, and advanced manufacturing can foster technological advancement and drive economic growth. Another sector is renewable energy and sustainable technologies. Given the global focus on environmental sustainability, the Chinese government can offer incentives for investment in renewable energy sectors like solar power, wind energy, and energy storage solutions. Supporting companies that develop and produce clean technologies such as electric vehicles and energy-efficient appliances can also attract investment within and outside China, which will lead to economic growth. China's economic crisis is a complex issue influenced by both cyclical and structural factors. While the country faces significant challenges, it also possesses strengths and opportunities for growth. Finding ways to address these concerns within global frameworks that promote open trade and investment will be crucial for navigating the uncertainties ahead. We hope you found this discussion insightful. Remember to like this video, subscribe to our channel, and leave your thoughts in the comments section below. Thanks for watching, and we'll see you next time.